In this short video, I want to answer an important question for savers and investors: an ISA or a SIPP. Two ways of sheltering lots of different investments from tax, but which one's best? Now, I'm taking some knowledge for granted here, so do have a look at earlier videos covering what is an ISA and how SIPPs can help pension savers, because I'm taking most of that for granted. So, in a nutshell, why would you not want to minimise tax? That sounds like a useful goal. ISAs, individual savings accounts, and SIPPs are both a way of sheltering what could be quite a similar set of investments within a tax shelter. So what are the main differences? And I'm going to argue in this video there are four that are worth looking at. How much can be invested, the tax position, because it does work differently for each product, how withdrawals work and what are the relevant penalties, and inheritability, so sort of the life cycle of both products, if you like. Now, there are one or two other aspects we could look at, but I'll limit myself to those here. So, how much can I invest? Individual savings accounts. The answer is, currently, 2015-2016, £15,240 per adult in a standard ISA, and that's per year. The amount you can put in changes each year. It's up from 15,000 last year, but that means that a married couple can invest just over 30,000 in 2015-2016, and the deal there, essentially, as we'll see in a moment, is once it's in, it is then free to grow without suffering further income tax or capital gains tax. In addition, you can put up to, these are up to, don't have to put the full amount in, £4,080 per child into a junior ISA and let that compound on their behalf, and there's no limit on the size of the total lifetime amount saved. So in other words, good luck to you. If you invest the maximum amount, it can grow to whatever sum it grows to. There's no lifetime limit, as there is on the SIPP side of the equation in terms of how big that account can get before extra tax penalties kick in. Now, what is on the right-hand side? The self-invested personal pension. And don't forget, I'm taking some knowledge for granted here. Well, 100% of net relevant earnings. Now, if your earnings are salary from an employer, it's essentially 100% of that, if you like, capped at £40,000. That does move, but capped at £40,000 in the current tax year. So the annual amount you can shovel in is higher. Limited to £10,000 under certain circumstances. I won't go through all of those here, I cover them in other videos, but if you're already drawing from an existing pension, for example, there are limits on how much you can shovel in to get the tax relief we'll look at in a moment. And there is a lifetime allowance of 1.25 million, dropping to £1 million from April 2016, we think. Now, that is a limit on the total size of the pot from which you can make standard withdrawals. More about that as a reminder coming up. Okay, the tax position then. It is different. ISAs and SIPPs work slightly differently. So with an ISA, here's the deal. There's you putting money in to an ISA, a tax shelter for a range of investments you've chosen, and at the other end, you're going to pull it out again. So what's the deal? The answer is there is no tax relief on the way in. So you have earned income which has already been taxed, presumably by an employer, for example. Now you're shoveling it into an ISA. What's interesting about that? Well, tax-free growth within the wrapper, and then no further tax on the way out is the deal there. So you've suffered all the tax up front when you earned the money you put into the ISA, and there's no further tax to pay. So quite a clean deal, you might say. With a SIPP, you and or your employer can shovel money into a tax-effective savings wrapper again. Similar investments could be under that wrapper, who knows. And at the other end, what you're aiming to do here is to pay for your retirement, the point where you have no income. At the other end, as a retiree, you pull the money out again. Now, tax relief applies on the way in, but not fully on the way out. So here's the deal with a SIPP. Tax relief, as a reminder, means effectively that for every 80p, if you're a basic rate taxpayer that you contribute, that can get boosted up to £1 thanks to the tax relief from the government. And if you're a higher rate taxpayer, there is a way, again through tax relief and a change in your tax code, to turn 60p from you into £1 invested. So that's pretty handy. And on the way out, worth noting, there's a tax-free lump sum available. So great, tax relief on the way in, tax-free lump sum, capped at the moment at 25% of the amount in the pot, but the remainder is taxed. So there's the deal. And when people are comparing ISAs and SIPPs, they sort of say, well, the ISA deal's simpler, I can have more than one every year, I can build them up. But do bear in mind, with SIPPs, note a few things which are often overlooked. You and your employer can contribute. Now, if your employer is prepared to contribute, that's kind of free money, if you like. There's tax relief on the way in and a tax-free lump sum on the way out. All right, and in both cases, there is tax-free growth within the wrapper. All right, and on the way out, don't forget, although the remainder is taxed, you do have a personal allowance and one or two other ways of reducing your ultimate income tax bill. Okay, so what does this mean? Snapshot summary. Let's compare a basic rate taxpayer, 20%, and a higher rate taxpayer suffering 40%. Let's do an ISA versus a pension, a SIPP in this case. The ISA picture doesn't really vary on either side. If your contribution was £10,000 initially, the value after 30 years at an assumed growth rate, now totally assumed, not guaranteed, of 6%, a middling growth rate if you like, you'd have 57,434 in both cases. If you withdraw an annual income at a rate of 5% from that pot, remember it comes out with no further tax, 2872 and 2872. Pretty simple, clean deal. Now watch what happens with the pension. Supposing you were to contribute £10,000 yourself, I'm assuming as a basic rate taxpayer you get an uplift to 12.5 via tax relief on the left-hand side. If that grows at my assumed rate of 6%, that gives you 72,000 more or less. Convert that into an annual income, and I've assumed this rate of 5%, and you'd have an annual income of 3,590. But we've said, assuming you've taken your 25% tax-free, that is taxable. So as a basic rate taxpayer, that would be reduced to 2872. All right, so a long-winded way of saying you're more or less in the same position. But let's look on the right-hand side here as a higher rate taxpayer, and here's a little kicker with SIPPs, with pensions. Okay, let's assume you organise things so that you get the tax relief on the way in, and any amount that you get clawed back through your tax code as a kicker, you also pay into the pension. So in a nutshell, your contribution of 10 generates an investment of around 16,667. Made a couple of assumptions there. That compounds at 6% up to 96,000 more or less. You take off your 5%, 4,786 gross, and after tax at your marginal income tax rate as a higher rate taxpayer, you're down to 2872. But here's the trick. What's that number just there? That looks a bit interesting. All right, that is making the assumption that on the way in, you get higher rate tax relief, but by the time you retire, you're not earning enough income, you're not generating enough income to be a higher rate taxpayer. If you're only paying basic rate tax on the way out, you get a bit of an extra kicker, a saving over the life of this deal. That's worth bearing in mind when you're looking at pensions versus ISAs. Now, withdrawals. I'm going to finish off with a couple more points. With ISAs, here's the deal. Funds can be withdrawn at any time from an ISA without penalty potentially. The full amount can be withdrawn, all right, and there are no tax implications of making withdrawal. With SIPPs, got to wait till you're 55, all right, so the tax relief comes at a price, and that age may rise, that minimum age. The full amount can be withdrawn, but be careful, only the first 25% is tax-free. The rest is subject to income tax at your marginal income tax rate, whatever that happens to be. So ignore the headlines that say you're going to pull it all out and it's kind of tax-free. It isn't. All right, so a couple of differences there to watch out for. Yeah, but people say, well, therefore ISAs are much more flexible. Yeah, but in reality, if you're planning to pay for retirement, most of us are not going to get to retire before 55 anyway, which makes that not too much of a kind of lock-in barrier, if you like. Okay, ISA inheritability. Now, just going to finish with the end game, if you like, the inheritability of these things. Under the old rules, ISAs were quite constrained. Any savings held in an ISA would lose their tax-free status, leaving any surviving partner to pay tax on income and any gains. A lot of people didn't realise that. They thought they could just sort of inherit it. That's changed. Under the new rules, a surviving partner or spouse only can protect the existing tax benefits of an ISA. I won't go through the exact mechanics here, but it's worth noting that changed relatively recently to introduce quite a bit more flexibility, at least where partners and spouses are concerned, around being able to preserve tax benefits when one partner or spouse dies. Worth also just clocking what's happened with SIPPs recently. Here, the deal depends on the age of the person who's died. If they're below 75 at the age of death, any beneficiary can inherit the entire value of what's in the fund potentially, and or get paid income via either flexible drawdown or purchase of a lifetime annuity. But that does hinge, because that sounds quite generous, that does hinge on the person who had the original pension arrangement dying aged less than 75. Once you get, and this is true for most people these days, once you get to 75 or more, and the government knows that, the deal changes slightly. Still any beneficiary, but they get a lump sum at the moment, less 45% tax, likely to become your marginal income tax rate in the future. And they can receive income, but again, doesn't matter who they are, doesn't have to be a spouse or partner, subject to that marginal income tax rate on income withdrawn. Okay, the conclusion. For most people, ISAs are a no-brainer for certain objectives, I would say. They're particularly useful for things like your rainy day fund, in case of illness and so on, mortgages, university fees and the like. Your sort of short to medium-term goals. The flexibility is good, but long-term, retirement planning, pensions and SIPPs definitely have their place. So for most people, the best approach is a kind of mix and match. A lot of ground covered there. Any questions? To the usual place.